Alright. Uh, yeah, good evening, everybody. Hope you guys are doing well. Thanks for coming on time. So I think it's 7:04 now. So let's kickstart today's lecture. Okay. We are recording. Okay, that's good. Okay. So before we start, just one administrative thing. I just want to let everyone know that the GBA groups have been released. So they are in our tutorial group. You'll find them in the announcement page. So in case you do have any issues with your grouping, do reach out to me before the end of today's lecture. Also, try to reach out to your group mates as soon as possible as well. As you know, sometimes you might have group mates that decide to drop the course maybe this after this lecture or even before this lecture. So you just want to be careful because if you do have a few group members that drop out, then we'll want to try to reallocate you accordingly as soon as possible. Right? So just reach out to your group mates, try to exchange numbers, and you guys should be fine. Any issues with the grouping so far? Yeah, I guess probably not. All right. Okay, so what we're going to do today? So today, we're going to cover an overview of the quantitative methods of valuation, right? So it's going to be an overview only because we are just going to introduce the four different methods of valuation to you, as well as tackle some a bit more basic concepts like discount rates, which is a recap for most of y'all that have done previous uh, theme modules. So it's just a bit more of a recap at the start, but then as we go on to the second part, or third part of the lecture, then there will be more slightly new information. Okay. So as a recap again, um, last lecture we covered the qualitative frameworks to use in your valuation. Um, and these quantitative frameworks, I think like we discussed during class, can easily take up about 45%, 40 to 45% of your grades of in terms of marks for your evaluation report, right? So it could be your GPA, it could be your ECA. Whenever you do a valuation, that easily covers 40% of your grades. So even though it's just one lecture, do not put too little emphasis on lecture one, because it's qualitative, meaning that it's quite broad, and so there'll be quite a bit of things to look out for, right? For qualitative. Now, then the quantitative component, which is today's lecture, where we do overview, um, is going to cover the other 55% or maybe 60% of the report, right? And in today's lecture and the next two lectures, what we're doing is today's overview. The next two lectures will be a deep dive into the methods, right? So there might be some component of the lecture where I would say things like, oh, we're not going to much detail today, but we'll cover in more detail in the next two lectures, right? Because then we have a dedicated lectures for two of the all the methods that we're covering today. Now, in terms of the class test, you know that the class test will be covering lecture one and two. So you expect that all the quantitative questions will obviously come from lecture two. And so we do need to know the basis of how you do some calculation, even though it's an overview lecture. And then, of course, the qualitative will be lecture one, right? Okay, so let's start today's lecture proper. So these are probably a recap. So what's a discount? What is discounted cash flow, right? I hope everyone knows time value of money. Is anyone hearing this term time value of money the first time? Okay, I guess No. Maybe you guys are still having dinner while attending a lecture. No worries. Okay, so because of time value of money, right? The idea behind it is that we need to discount various cash flows now, right? Because of the idea of time value of money. So discounting becomes important. Then the question is, why is cash flow important, right? Because we are in the module of valuation, means that any asset that has some kind of cash flows in the future, which then will be discounted to the present, will have some value, right? So any asset that can generate cash flow, it could be a financial asset, which is what we're focusing on, but it could be a physical asset as well, right? A house, maybe renting a house out, so you get some rental income. So that is cash flow to you. And so all this cash flow means that the asset has value. Okay, so just going to highlight discounting the future benefits to present day because of time value of money. Um, any asset that an asset is worthless if it does not give you future cash flows. And then we have a discount factor, right? Which we are going to dive deeper in the next slide. So, again, how we are going to structure this discussion is like what we did in the last lecture, where we are going to cover different techniques to use, right? And at the end of the day, which technique you choose is based on your assessment of the company, of the valuation that you're trying to do, right? So even for this discounting of the cash flow, you'll see various techniques to use as well. So um, basically, when we think about discounting the cash flow, what's important is the discount rate, right? So the discount rate is important, and because of this, in our valuation, there are two key discount rates that you might want to consider depending on what we are trying to value. So, if we are trying to value equity of the company, then the cost of equity is important. Then, the cost of equity will be the discount rate. Now, if we are valuing the firm, the cost of capital is important. And yes, actually, I wanted to ask the question, does everyone know what is the cost of capital? And I already see the answer on the chat. The cost of capital is your WACC, right? WACC. So the WACC is your cost of capital, which will be used for valuing your firm, right? Besides the discount rate, what's interesting is that we can discount the cash flow using nominal terms or real terms, right? And what's the difference between nominal and real? Inflation accounted for in real. Perfect. You're right. So depending on what we are trying to focus on, are we thinking about real terms or nominal terms? We use the various real discount rate or nominal discount rate. Okay. Um, Something that's important is that we need to be careful that to kind of understand how the discount rate fluctuates over time, right? So when we do your valuation report, chances are you're going to value the firm for maybe next 5 to 10 years, right? So perhaps there might be a change in the risk-free rate over the next 5 years, right? So the discount rate can vary over time, and so do not be focused or do not think that okay, there's one discount rate that I have calculated, and this will be a discount rate used throughout my entire valuation, right? Chances are you will need to consider discount rate changing over time, right? Again, it's up to you because valuation is a very broad technique, right? So it's up to you whether you feel that the discount rate should be the same or you should change over time and provide your own justification when you do your valuation report, right? Why should it be changing or why you feel that, hey, you know what, the discount rate should stay constant. It's really up to you. Of course, your justification is the one that would provide you the marks in terms of why you are choosing one discount rate versus five discount rate, right? So there's no right or wrong. Again, in valuation, it's very subjective. Valuation is kind of like an art form rather than science. There's some science to it. You need to know the basic framework, but at the end of the day, it's an art form, right? Okay, then estimate the currency of the earnings, the cash flows, um, to the asset. So basically, we want to think about, okay, is this the cash flow to equity or cash flow to a firm, right? And we'll talk about this in much detail later. We need to estimate some kind of cash flow in order for us to do the discounting. And at the end of the valuation, we typically need to assign a stable state or stable growth state in our valuation, right? And this will be the terminal value of the firm. So this terminal value is where the firm now grows at a constant pace. And we need to kind of define the characteristics of this constant state, right? So we're looking at it with more detail in a bit in the next few slides. Last but not least, we need to choose the right, there's no right or wrong, but the appropriate, I would say, discounted cash flow models. And we'll cover four today. Um, so this is a bit of a repeat again, depending on what we are trying to uh, find, equity versus firm, nominal versus real, and then maybe a small uh, point to discuss is the currency, right? What's the currency of your cash flow? So do not assume that when you look at a financial statement of a company listed in Singapore, the currency is going to be Sing dollars, right? If it's a trading company, chances are they might actually do their reporting in US dollar because most international trades are done in US dollar, right? And because and if you know, so this is important, the currency, I put a star here, right? So if you know that the company does most of their trades in the US, perhaps your discount rate that you use should reflect the discount rate of the US, right? So you need the US rate. So this is important, right? So do not assume immediately that, oh, I'm going to value a Singapore company, I must use the Singapore rates, right? And when I talk about rates, is your risk-free rate, right? RF, the risk-free rate. Of course, RF, you still need to do some stuff to get your cost of equity, to get your cost of equity at the end, right? And WACC, right? In the end, you didn't get it, but you might be using the US rate instead of Singapore rate. And so this is where your justification comes to play, where you need to make appropriate justification in your valuation report, right? Any questions here? So this is important. This is important. So we do see past semesters where sometimes they choose companies that maybe have a large exposure to the Australian market, and then they use Singapore discount rate. And unfortunately, when you do this, um, you know that the discount rate plays a large role in the valuation of the firm, right? Because it is the denominator component, and therefore your valuation is not uh, really correct. All right. Okay, so I hope I stressed this point. If you do have questions, so feel free to type in the group chat. Now let's go to the cost of capital basics. Um, the idea is of this, right, in layman terms, is this, right? The higher the risk of that company, the higher the returns, right? So higher risk, higher returns means that the cost of capital will be higher, right? So risk and the cost capital kind of, is related, right? Cost of capital, cost of equity. They are kind of the same thing, meaning the discount rate is related to the risk level. So a firm must earn at least the required returns to compensate what the um, debt or equity holder contribute in terms of capital to the firm. All right. So there are two things we want to look at: the cost of equity and the cost of debt. Okay, let's look at the cost of equity first, right? For the cost of equity, basically is the return to the equity holders. And this return will include business risk and financial risk. So I do have a question here. What is business risk and what is financial risk? Anyone would like? You can unmute yourself or you can type me a group chat. M is one of the methods to calculate cost of equity, but actually, what is actually the business risk and what is financial risk, which is included in this cost of equity? Okay. So financial risk is relating to your debt, your solvency of the company. You're right. You're right about debt obligations. That's right. Yes, and business risk is relating to operations. I do see the answer there. Yeah, operations. Okay, I do see a few people. Yeah, financial risk is there. Business risk operation. Yeah, totally right. So that's the difference, right? So the business risk and financial risk basically give you the company as a whole, right, in terms of the risk, because your company has the debt related kind of risk, and of course, its operations is so it's part of the risk to consider, right? Whether a company can meet um, the required gross margin, right? So these are operational kind of decisions that need to be made. Very good. Okay, so in our cost of equity, we're going to use three different methods to determine cost of equity. Then the question is, which one should you use in your valuation report? So this is where, again, is art form in the sense that you have to provide justification, right? You can use one method, two methods, or a combination of methods. So it's really up to you on what you want to use for your valuation. But whenever you choose a method, do provide justification on why you think this is a better method to use. Right? So let's cover the three methods. So method one. Method one, I would say, is the most basic kind of understanding of how we value or how we obtain the cost of equity. Right? We know that a bond is less risky than equity, right? Equity is more risky than a bond. And the difference between the equity and bond risk would be the would be this equity premium between them, right? In terms of return. Because remember the return and risk are proportional, right? Higher return, higher risk. So by looking at the returns, compounded returns, we can determine the equity premium when we compare let's say a risk-free bond with a compounded annual return of a particular equity. And so this will be an equity premium. And so by using, let's say, your historical data to determine your equity premium, we can then define what is your cost of equity now based on the equity premium plus your bond yield, right? That's the first method to use. So this is the, I would say, most rudimentary, the simplest method. Typically, we don't usually use this. And what we typically use is method two, which someone already typed in the chat called CAPM. But let's dissect CAPM, the CAPM model, right? So the CAPM model starts off with the idea of beta, which measures systematic risk. So beta is not like a random kind of Greek alphabet, right? Beta or something. So actually, what is beta? So the answer that here says beta measures systematic risk. But then the question is, what is systematic risk? Anyone like give it a try? What is systematic risk? Okay, sensitivity to market movement. Yes, there is some relative movement, relative volatility to the market re- compared to the market. You're right, risk cannot be diversified away. Unavoidable risk. Interest rate. Okay, yeah, so interest rate is one good example, right? So, okay, market risk, this is going to be a bit off already, right? So systematic risk is something that must be very intrinsic in a company, right? Non-diversifiable. All companies will have this, yeah, something that is going to affect the company, right? So it's intrinsic into the company. And that is a systematic risk. Whereas unsystematic risk is something that can be diversifiable, where we have a well-diversified portfolio. So your beta basically measures the systematic component of your risk and is always relative to the market. So when we say relative to market, so what is the beta of the market? Or what's the beta of the market? One, you're right. So beta of the market is one, and that is it's a defined beta, and your T bill is therefore zero, right? There's not going to be any risk or systematic risk. So anything that's more than one is riskier than the market, less than one, uh, less risky than the market, right? So that's your beta. Now, in this method of CAPM, what you can do is you can actually calculate beta by regressing the stock return against the market returns. Now, this is a technique you can use in your valuation to determine the beta, right? Now, the question is, do I really have to do this regression, or can I just plug the beta from Yahoo Finance, Refinitiv, or Bloomberg? The answer is it's up to you again, right? So you notice that this course, it's really your choice of whether you have to do it or not. So if you want to put in like the A plus effort, right? You want to, really do a very robust report, what you can do is you can do the regression of your market returns against your stock returns to calculate your beta. And maybe from there, you just reference the beta from Refinitiv to compare and so-called back test whether their beta is correct, right? So you can actually do this regression. And if you do it, of course, it will be really a plus kind of answer to actually compare your regression versus what is being produced in the paid platform. And so that's how you can calculate beta. Questions? Okay, so your data is just the first part of your CAPM model. Um, Earlier, we kind of understand that there's a kind of an equity risk premium when we invest in equity, and it's usually the difference between the risk-free bond and the equity. And so generally, a higher beta means you're going to take on more risk, will give you higher returns, right? Greater risk premium, higher returns. And by doing so, we can actually plot the graph of returns against your beta. And it's expected that as your beta increase here from zero, your returns is going to increase as well, right? Because you're taking on more risk. Then the question here is, we do have two key points that we identified earlier, the market beta, which is given by the return on the market, and your risk-free beta, which is zero, given by your risk-free return. Now, having 2 points on the graph here, now, what is the equation of the line? The question is what? Anyone knows what is the equation of a straight line? Y equals mx plus c. Thank you for the answer. So you're right, y equals mx plus c, right? So having this graph here, we can actually do the y equals mx plus c, where y equals to the m, which is the gradient, e r m minus RF divided by 1 minus 0. The X is E R I plus what's the C? The y-intercept is R F, right? So I hope you all can see that this is actually equals to what's written here, which is simply the CAPM model, right? The CAPM model at the same time has some kind of specificities where it assumes a diversified kind of portfolio, right? And it only takes into account systematic risk because we are plotting the beta against the return of the asset. So the beta, of course, is only the systematic risk that we are measuring here. Okay. Um, so some comments is that this security market line represents a market equilibrium. The slope gives you the risk and reward ratio, so meaning that the more beta you take, the more returns you get. Um, and you can kind of calculate the market risk premium, which is given by the expected return on market minus the risk-free rate. Okay. So more formally, this is the CAPM model here. Something to keep in mind is when you look at questions, do be careful on what they give you, right? So in the CAPM model, this is considered the market risk premium given here, right? So in case the question gives you the return on market, which is this thing, i.e. this thing, right? You need to choose less of uh, your risk-free rate. Yeah, right? So whenever you solve questions, whether is it your class test or your GBA, just be very careful on the information that's given to you, right? Whether is it the return on market or is it the market risk premium. All right. So that's method two, the CAPM model. Method three is just using the growing perpetuity formula, right? So in case you kind of forgotten what is a growing perpetuity, feel free to look through the first lecture. At the back, we have some self-review on time value of money. But the idea behind this is that by having this growing perpetuity, what we can do is we can rearrange this formula to make this component here the subject of our method, right? Where RE gives you the return on or the return on equity for this formula. And so by if we have the dividends, we have the price of the stock, and we know this growth rate, which we are going to talk about in just a bit, how to calculate this G, then we can actually calculate the return on equity using this growing perpetuity formula. Something important to take note is that D1 in this formula is the dividends that you're going to get next year, right? In year one. So if the question gives you dividends now equals to D0, right? And if it's D0, you need to multiply it by, sorry, then you need to multiply it by 1 plus G. Okay, so next year equals to D1. Okay, that's something important to consider. All right, so that's all for cost of equity. Now, in terms of cost of debt, the cost of debt, again, we have three different methods to calculate cost of debt here, right? We'll go through all three. But what's important is that the cost of debt is not the coupon rate. It is actually the yield to maturity. So I do have a question. What does coupon rate mean? And how is it different from yield to maturity? Okay. Yes, it is like I think what you're coming at is kind of correct. So coupon rate is kind of fixed, while with maturity is not. Coupon rate is fixed interest rate. Okay, so the coupon rate, right? Okay, so how do you think about this? Um, the fixed rate, yeah. So it's the interest they get from the bond, right? So just a small recap for those that kind of forgot what is a bond. Okay, so a bond is like a piece of paper, right? It says that, let's say you lend money to a company, right? You take $1,000, you give the company $1,000, and the company gives you a piece of paper. And this piece of paper is called the bond or an IOU paper, right? Now, in the most simple sense of a bond, what happens is that at the end of the, let's say, 5 years, the company is going to, or you are going to bring this piece of paper that the company gave you, the IOU paper, you give it to the company, and the company is going to give you back your principal, right, of the 1,000 that you have gave the company at the start of the 5 years. Now, then the question is, where is my interest? So the interest is in your coupon rate. So I see the answers in your chat, which is right. So it's the interest rate on your bond. So this is the most simple sense, right? Because we have a lot of fancy and different bonds. Now, then your coupon rate is the interest, and then the yield to maturity is your rate function in Excel, right? It's a rate function where you're actually calculating what is the yield of the entire bond based on how many years to maturity and everything, right? So not just the coupon, which is the interest rate, is the interest, but actually the yield, right? What's the actual yield? Okay. For cause of that, what's important also to consider is there is some kind of tax shielding that happens, right? So whenever we consider that, there's going to be a portion that is shielded from taxes. And the reason why is because imagine this, right? We have our EBIT, earnings before interest and tax. Now, our EBIT is going to, you're going to remove interest. So that, if you take on that, you generate interest, right? Interest payment, you can pay interest. So your interest component here, it is where you're going to deduct from your EBIT, right? You're going to deduct interest before you put a tax rate to it. Now, because you deduct the interest, what does this mean? It means that the earnings you have is less, right? There's lesser earnings before you apply the tax rate, right? Before you apply the tax rate here, right? There's lesser earnings. So in this sense, your interest is actually reducing the amount of earnings you have that will be taxed, which is why you are going to experience a tax shield effect. And so because of this tax shielding effect, the interest is therefore tax deductible. So please remember to always consider the tax effect on your cost of debt. We have three methods. The first method would arguably be what you would most likely use, right, in most cases. And it's to look at the existing cost of debt, right? So imagine the company has existing debt. So look at the current debt and kind of determine the yield to maturity. Yeah, right. So when you determine the yield to maturity, we can use the rate function on your Excel. And let's look at this example here, right? We have a 15-year bond, right? 15-year bond, coupon rate 12%, semi-annual, and currently the bond is priced at this. Okay, so whenever we have these things semi-annual, right? Always convert all your attributes, these are attributes, right? Convert all your attributes to the level of the compounding effect, right? The lowest level. And in this sense, the lowest level is semi-annual, right? So convert everything to semi-annual. So how do we convert? Means that the number of years need to times 2. The coupon rate, you divide by 2, right? So in case the question is now quarter, then you need to times 4 divided by 4, right? So always bring the attributes to the lowest kind of compounding factor or compounding period, right? So if it's semi-annual, divide by 2, quarter divide by 4. Okay. Now the thing is, we should not bring it to bring up. So what does bring up mean? Means that if it's a semi-annual, do not take 15 years divide by 2, meaning become 7.5 years. Do not go up, right? Why? Because when you go upwards, you will need to consider the compounding effect on the attributes. Very important point. So whenever you are dividing your number of years or multiplying the number of years or dividing the coupon rate, always go to the lower compounding period that's stated in the question, meaning that whatever stated is normally annual. So if it's a semi-annual compounding, go to semi-annual, right? Do not reverse the way you do it, where if it's semi-annual, you divide the number of years 15 by 2, meaning you get 7.5, and then you multiply the coupon rate by 2, becoming 24. If you do that, your answers will be wrong because you did not consider the compounding effect, right? So by making sure that you bring your attributes to the level of the compounding, the lower level, which is in this case semi-annual, what you have calculated when you do your rate, it's only half, right? It's only half. So you must remember to multiply by 2. So this one is important, right? So sometimes you you calculate very quickly and it could be an MCQ question, and then you just, oh, there is an MCQ answer where it's not multiplied by 2. Obviously, they're trying to trick you, right? And so you just put the answer without realizing that you actually need to multiply by 2. So just be careful. Occasionally, you might see something like quarter as well, and it means that the rate that you use must multiply by 4. Any questions on this? This is clear. Okay. So these are small, I would say we could be even call it careless mistakes that is relatively common, right? So just be very, cognizant, like, okay, just be very careful on this kind of small things. Okay. Now, this method is, let's say the company is just going to be the first debt they're going to issue, right? It's not very common. Most companies will have that. But let's just say that it's a new debt, right? Totally new debt. Yes. So you should give the same answers as well. You can give it a try. You can use rate or you. Normally, I like to use rate, but I can give you a try because the rate function relates more to your time value of money in terms of your PV, FV, TMT, right? So all these are all related to the rate functions. I can't like use rate, but yeah, you can use you as well. Okay, now for method two, thanks for the question. For method two, we are using new debt, right? So the idea of new debt is what? The company has not issued any debt. So now let's try to determine what is the cost of the debt. And first of all, the first way to determine the cost of debt is let's rate the company first, right? Let's try to do a rating of the company. By rating the company, what do you try to get? You're trying to get the default spread, right? Based on rating, there's going to be some uh, expected default amount. And based on this default amount, we can determine the credit risk premium of the company, right? So the credit risk premium, one of the major component is your default risk, right? So higher default risk, the higher the credit risk premium. And so by having the credit risk premium, then we add the risk-free rate, we can get the cost of debt. Okay. Um, at this point, I want to highlight something, right? That this credit risk premium, right, is not only equals to debt, right? Not only equals to the default spread. So your credit risk premium, yes, a big majority is default risk, but there are many different risks as well, right? It can be things like sectoral risk, right? So which sector the company is in, right? It could be also country risk, right? You probably see some if you search or even just type on Gemini or ChatGPT, what are the components of credit risk? You'll see a whole list, right? It could be country risk as well, where depending on which country the company is incorporated in, there could be higher risk, right? For example, if the company is incorporated in the US, maybe it's okay. I mean, it's a highly rated country risk um, location versus, let's say, maybe in China, right? China, because of the political situation, can be a bit higher risk, right? So it depends on the credit risk depends on many factors. So just for your own information, just be careful that when you think of credit risk, do not straight away, because of this slide count, conclude that hey, it's just a default risk. There are actually many risks involved in your credit risk. Okay, the credit risk premium depends on the credit rating and the maturity or the tenor of your debt. So of course, the longer the debt, generally your credit risk is higher, right? Because the higher chance for the company to default. Generally, when we think about credit spreads, they are quoted in this thing called basis point. I think a handful of you already have started working, so you might, if you're in the finance sector, you might see this BP. So basis point, what does this mean? It means 100 basis point is 1%, right? It's just it's kind of simple way for people to represent percentage. That's all. So sometimes if you are using those platforms to get some market intelligence for the company you're trying to value, you might see this basis point as well. So do not be too surprised when you see this basis point or BP. Okay, so the last method is rating a bond, right? So this one is really more for when you are issuing a bond, right? When you are actually issuing the bond to the market, and when you issue a bond, most company would engage a rating agency to rate their bond so that they can get investors to buy into a bond, especially if the bond is well rated. However, of course, higher rated, well-rated bond means that there are lower returns, right? So let's say if the company want to pay lower interest payments, so the company issuing a bond want to pay lowest interest payment, the incentive is for them to get a better rating on their bond from the rating agency. So a lower rating would means higher credit spread, higher interest the company has to pay. So this is the standard rating. So you have a typical rating agency like Moody's, S&P, and Fitch, right? Those are our main rating agencies. We do have the last component. So we have talked about cost of equity, cost of debt, and we have this cost of preferred stock, right? So cost of preferred stock, it's not super common in Singapore, but if you do look at financial statements of European companies or even American companies, you're going to see this preferred stock more and more, right? And so preferred stock are generally stock that pays constant dividends, but at the same time, it means that they do not typically have voting rights, right? So it's almost act like a bond, right? With no voting rights, but a constant payments. So because of a constant dividend payment forever, they can be treated as perpetuities, right? And this is a perpetuity formula, right? So we do have a question here. We have a preferred stock from Water Industry INC, currently selling at 36 per share, paying $2.5 in terms of dividends. So what is the cost of capital based on the preferred stock? So we just take 2.5 divided by 36. So we have covered the three components of what we are going to now call the WEC, right? So this again, it's a recap for many of you all. This WEC concept, which is the cost of capital used to discount. So this one is used to discount what? Is it the cash flow to equity? Is it? So it's the WEC used to discount the cash flow to equity. No, it's the cash flow to firm. You're right. It's the cash flow to firm. Okay, so the firm, so because we are looking at the WEC, it means that we are considering both the equity and the debt structure of the company, right? So because of that, we need to have some averaging, and so we use the weighted average of your debt, equity, and preferred stocks to determine your WEC. So the WEC comprises of three components. Typically, it might be actually more two, just equity and debt. Sometimes you have preferred stocks, right? So what's important here? The weight used for your weight. We need to use the market values. So this is important. We need to use the market value. I do have a question here. Is it practical to use the market value? If yes, why and how can we obtain it? And if it's no, why? Okay, I like the answer. You're right. So for equity, no problem, right? Generally quite easy to obtain. No big issues. Now, the debt one, you're right. I would say it's not impossible. So recall what is debt. So debt, let me just use this color. Debt equals to bonds plus loans, right? Generally, it's just bonds plus loans. So bonds. Is it difficult to get the bonds market value? Easy to get? You're right. It's easy to get, right? Bonds easy to get. Now, the loans. This is the one that's tough, right? Because your loans is on your balance sheet. They are typically recorded in balance sheet at book value, right? Book value of the loan. The loans don't really fluctuate, right? So, in a sense, let's say you're doing your valuation, right? So your valuation, when you look at your market value of debt, you're going to have a combination of both book value for the loans and market value of your bonds. So it's going to be a combination. I hope you can appreciate this. So these are the subtle difference that if you point out in your valuation report, it will distinguish you from a B report to an A report, right? So these are the things that you need to be considering. So in your debt, if your company has bonds, you must use the market value because that is easily gotten. If you use the value for your bonds, then the marker is going to say, hey, you know what? You actually have the data. How come you're not using that? Because you lose some marks from that portion already, right? Equity, for equity, nothing too contentious. It's easy get. You must always use the market value. If you're going to use your book value for the equity in your calculation, immediately you're going to lose marks. And your valuation or your WACC calculation, you're not going to get it right? So any questions on this? So this is important, right? What to use here as market value. So this is very important. Any questions? No? Okay. So hopefully you're making like small notes here and there on the side. So when you do your valuation report, you can kind of follow, all these small little tips that's discussed in class. Okay. Now, in terms of your cost of capital, cost of debt, cost of preferred stock, we have discussed this. Again, I would like to emphasize that you can use one method, CAPM model, let's say for cost of equity, or you can use multiple methods and find the average. Really up to you. Okay. Do not forget the discussion we had earlier about the risk-free rate, right? Which risk-free rate should you use? Do not straight away assume that we need to use Singapore risk-free rate because we are in Singapore or the companies in Singapore. Try to think about things a bit more like, okay, yes, this is a Singapore company, but are they actually operating mainly in Singapore or are they maybe actually using US dollar or maybe Chinese yen? So just be very careful on this, okay? Last but not least, the corporate tax rate. Corporate tax rate, fortunately, it for Singapore companies that is traded in Singapore Stock Exchange, there's going to be a corporate tax rate that's applied. The Singapore corporate tax rate is very easy, 17%. But on this point, I just want to highlight to you that in case you are ever going to value a European company, generally in Europe, there's going to be a graduated tax rate, meaning that depending on your income bracket, is going to increase the tax amount that you pay. It's almost like your income tax, right? I think some of you are working, you know that at different income level, you're going to pay tax at different rate. Similarly, for a company in Europe, they're going to be taxed differently as well. In this case, we need to consider the incremental tax rate for our valuation. Can anyone explain what is the increment? What does incremental tax rate mean? And why do we need to use incremental tax rate? Okay, yes, it's a tiered system. But tiered system, then why? Why do we need to use incremental? Yeah, right. I really like the answer. For every next $1, how much you need to pay in tax? You are totally right. So because we are doing a valuation, right, we're not super concerned about the tax rate now because it's about what you earn in addition and does it push you to the next level of the tax bracket. Right? Obviously, if it doesn't, then that's fine. You can use the whatever tax rate that is being charged to the company now. Let's say the tax rate is 10%, and the incremental tax rate based on extra dollar or extra obviously it's not $1 because the company, right? Means 1 million, 2 million, whatever. It's not going to push the company to the next level of the tiering, then that's fine. You can use the 10%. But if it's going to push, then you need to use the incremental tax rate. Right? So this is important. Okay. So while we have this kind of uh, idea that we should use the target rate, so this is the best. This is the A. I'll say A. If you know there's a target rate, a target weight of your debt and equity, go and use it. But most of the time, chances are you are not insider of the company, right? You do not have insider information. So you are going to use the market value. But even when you use market value, do be careful on the debt component because that one you do not necessarily have all the market value of the debt. If your market value is not available, then the last choice is value from the financial statement. Generally, this is for more for private firms, right? Private firms. Okay. Because if you are doing uh, valuation of a public firm, you must for sure have some market information. So again, it do not use the information on your financial statement or your balance sheet. Please do not use it because if the market sees that, immediately you're going to lose at least 50% of your WACC mark, right? So please always use at least the market value. Okay. So we have two discussion questions. This one, I will let you go through on your own, but I want to do the second one with you together. Okay. So we have this question on WACC. We are given information on equity, right? We have 50 million of equity, $80 per share, beta 1.15, market risk premium, and risk-free rate, right? So we're given some information and a debt as well. We have a outstanding debt of, this is a mistake. I think it's not 1,000 million. Let's see. Okay, it's just 1 million. It's not 1,000 million. Please change this. So just 1 million. 1 million outstanding debt. Okay. Current value 1100. Corporate rate 9%, semi-annual, 15 years, 40%. Right? So these are some information. Okay. With the information given to you on the cost of equity, we can kind of determine using CAPM easily, right? We have the beta, we have what they give you? They give you market risk premium. So I'm going to put a star here. It's the market risk premium. So it's not the return on market. Okay, the risk-free rate is given to you as well. We can calculate cost of equity. Now, the cost of debt, on the other hand, because it's a semi-annual, so semi-annual, everything again, I'm going to repeat this, probably a broken record to those that already is very comfortable with time value of money, is that we always need to convert our attributes to the lower denominator in terms of the compounding period, right? And in this sense, the conversion is to semi-annual, meaning that we're going to multiply by 2 for the number of periods, and for the payment, which is your coupon, we're going to divide by 2 here. Our present value is given to us at 1100. So 1100. Now the question is, okay, why is it negative here? Right? And we know that par value is always 1,000. So in case the question don't give you what's the par value, it's always assumed as 1,000. Now, the question is, okay, why is present value negative, future value is positive? So normally I like to explain to the class about this. In case you kind of forgot about how we determine positive, negative, you can use this analogy, right? Always imagine the money in and out of your own pocket. So what does this mean? It means what? Okay, you're going to buy a bond. And when you buy a bond now, the present value, you're going to take money out of your own pocket, right, to buy a bond. So you're going to take out 1100 from your own pocket, and this to you is a negative, right? Because you're paying money out of your pocket. So it becomes a negative here. At the end of the bond period, we are going to receive back the money, right? Because bond is basically a loan to the company. So you're going to receive back the money. It's a positive to you. So this method of thinking when it's positive, when it's negative, will always make sense and will always give you the right answer, right? In some calculations, if you flip the negative and positive, it might not affect your answer. But in other situations, is going to affect the answer. So instead of guessing, it's not a guessing game. It's not like, oh, so I think it's positive, I think it's negative. No. Just always think of it from the perspective of your own pocket. If money is coming out of mine, it's going to be negative. If money is going into my pocket, it's positive, right? So it's not a guessing game. Having understand this concept, then we determine the rate, and we remember multiply by 2 because this is semi-annual. That is tax deductible. So we have after tax cost of that. And then how do you determine the weight of the structure? So in the question, we are given a few things. We are given this, right? 1 million outstanding debt, current value is here, right? So we can calculate what is the market value of your equity. We can determine the market value of debt. On this point, I want to highlight to you here. You must use the 1100. I put 2 or 3 stars here. Please always use the current value of your debt here. Okay? Do not use par value. Okay? Always use the market value, not par value. This is very, very important. So in case you have some MCQ questions, they typically like to trick you in this sense. When you determine the market value of debt, use the present value of the debt, right? So 1100, 110 here. Okay. After determining this, you can calculate the weights and you calculate the WACC. Any questions for this? So there are some key important points to take note of when you do your WACC. They're not difficult, I would say, and I believe most of this is a recap for you, but there are just some pertinent points to keep in mind when you do, like for example, what numbers to use for your market value of debt, as well as also when you put negative, when you put positive for your time value of money calculations. Okay. All right. Now I think this is a good part to pause. Let's take a break. As usual, we like to do 2 breaks for our class. So we'll take a 7 minutes break. We come back around 8:15 before we continue on the first valuation technique. All right, welcome. Uh, Hope you have a good short break. Go for a toilet break, maybe get some tea, maybe coffee, if you can drink coffee at night. Um, okay, let's continue. So far so good for everybody. Yeah, so far okay. Most of the is just a recap, right? I think should be pretty alright. Okay, so let's go for the first valuation technique. Valuation with dividend, right? So perhaps it will be the simplest version of valuation. So in short, we call this the discounted dividend model, DDM. Okay, so DDM is more suitable, of course, when the company pays dividends, right? If it pays dividends, then you can actually can use the valuation using DDM. Um, if the company has some established dividend policy, that will be, of course, also useful. So if you use dividend discount model, because if there's no established policy, one year is high, one year the other year is low, then it's very hard for you to value a firm based on DPM. Now, the next point, when the investor takes a non-controlling minority interest. Okay, this is a very interesting point. Anyone can explain why when we take if you are investor taking a non-controlling minority interest, DDM might be more relevant for you. So the question is, why when we take a minority interest, DDM is more relevant? So it might be a bit of a, I would say a bit of a tricky or not an easy explanation. Okay. Perhaps it's a bit tough. Okay, so let's try to understand what is minority interest. Does everyone know what's a minority interest first? Or no? Okay, no. Okay, so let's try to understand what's minority interest. Okay, so this term minority interest, right, is accounting term, right? So in accounting, what happens? Imagine you have a holding company here, right? Holding company, holdco, and your holdco owns subsidiaries, right? As subsidiaries. Now, sometimes they can own a subsidiary that's 100%. Okay, they fully own a subsidiary. It can own a subsidiary that is 80% here. Okay. I see the comment about share buybacks. Not really, right? Okay, so let's try to understand. So if we have a subsidiary that's 8%, what happens? There's actually 20% of this subsidiary that is owned by Y, right? Y investor. We don't know who, right? Why? 20%. Now, then this 20%, this is the minority interest here. Okay. Then the question is, okay, so this minority interest, fine, right? We know that this concept minority interest. In accounting rules, what happens? Any subsidiary that is more than 50% owned or have management control will be consolidated in terms of their financials into the whole team. It will be consolidated into the whole core. So because of this, even though you have 20% for this subsidiary, this one, there's 20% that is not owned by your whole core, but because of accounting rule, you're going to consolidate it there. There's this 20% that will be shown in the balance sheet and the income statement, P&L. There'll be this thing called NCI here. And this NCI is the share of profits for your minority interest and your E of your minority interest that is being shown in your balance sheet. Okay, everyone clear about this? What's NCI? So that's NCI. NCI is non-controlling interest. So it's called non-controlling interest, right? Normally there's no minority here. It's non-controlling interest. So have you understand what's an NCI, which is a purely accounting concept, right? And the reason why NCI exists is because of this 20% that's owned by an external party of this S here, which is then consolidated into the whole co. Yeah. So there are many companies that have this structure. Many, like almost any blue chip listed company will have this structure. And you're right. ST Engineering Limited has many of these NCI. If you go into their financial statement now, on their balance sheet, you will see the NCI in the equity, and in your P&L, you'll see the NCI in below the net income, right? So if you're interested, you can go and have a look. You'll see that there. Okay, so as a NCI, your interest is just basically getting dividends. Okay, and this because of that, this Y here, this one, these people here, Y, because they're just interested in dividends, their best valuation method would just be valuation with dividends. That's all, right? Then the question is, why are they not interested in other things, right? We will see this in the once we learn the overview of the four methods, right? This is the first method. Once we learn the four methods, we will realize that actually, as an NCI, as an investor, you're just interested in dividends, right? You can think of it in the most extreme sense. Like let's say today you have $200, 200 US dollars. You can actually go to buy Nvidia share, right? One Nvidia share now, I think, is around 188. Let's just say 188 or 190, right? 190 US dollar for one share. Okay, having bought one Nvidia share, you are now a NCI, right? Non-controlling interest in Nvidia. Now, are you very interested in uh the cash flow of Nvidia? No, right? Maybe I'm just interested in stock appreciation, how much dividends you get. And so if you want to value a firm, maybe you just use the dividend as a method of valuing the firm. You're not so interested to do a whole, FCFE. You'll hear about this in just a bit. The free cash flow to firm, free cash flow to equity. Those are just a minority interest. So this is an extreme case, right? Of just owning one share. So you're right. I really like the question here. Does Y have the right to decide anything of the related party? The question is, or the answer is, it depends, right? I really like that question because it depends on whether nowadays there's this uh thing where the NCI group together, right? The NCI group together to be able to have enough say to decide things for the company. So let's say we have this subsidiary here S, and let's say it's 53% by the whole co, and the rest, which is 47% by NCI1 and NCI2, NCI3, right? We have three NCIs. So if the three NCIs, one, two, three, together, they have actually 45% of the voting rights, which is quite substantial. So they potentially could influence the company. However, as an individual NCI, you can't, right? So there's a point here that generally DDM is applied to mature companies that are not really in a growth stage. Why? Because normally a mature companies will be distributing dividends quite constantly, right? So which is why using DDM would be right way. Generally, most companies that listed on Singapore Stock Exchange are mature companies. So dividends are distributed based on the earnings of the company, a portion of the earnings, right? A portion of the earnings to the shareholders. Uh, any dividends that you have must be declared before they can be distributed. So whenever you look at a financial statement, when you do your valuation, what's important is to see the dividends amount being paid. Let's say you have to do this DDM, right? The amount of dividends being paid is whatever dividend is being paid in that year. Now, it is extremely important, I would say, couple of star here, to look into notes to financial statement because most of the time the company will declare the dividends at the end of the reporting period or during the reporting period, let's say during the reporting period, only for it to be paid in the following reporting period. So I repeat again, whatever dividends you see as a in the income statement or balance sheet, right, might not include dividends that is declared but yet to be paid. So you need to look at the notes of financial statement. So because let's say you know that the company has already declared the dividends, then you must do some adjustments to your DDM model to include the amount of dividends because if it's being declared, it will be paid. Right? This makes sense to you. So any dividends must be declared unless it's preferred. Okay, so but obviously it's a Singapore company, preferred one is very rare. So it must be declared. So do not stop at looking at the financial statement and say, oh, okay, dividends amount is $20. Okay, not $20, but maybe 20 cents per share, and that's all. Do not stop there. Always go to the back of the notes, the financial statement, look at the financial statement and see, okay, yes, it's $20, 20 cents me, but are there any declared dividends that has yet to be paid? Those must be included or should be included. And when you include it, of course, justify why, right? Hopefully you have these tips at the side of your notes to say, okay, I need to explain why. And the reason why is that whenever a dividend is declared, it will definitely be paid. If a dividend is not declared, the reverse is true, no payment. We have this thing called payout ratio, which is the dividends divided by net income. And so the amount of dividends being paid really depends on a couple of things, right? They can use a few different methods. Maybe the one of it could be a constant payout ratio. It could be a constant dollar, or constant dollar means you always pay out maybe 20 cents per share, or just a residual method where after meeting all the cash requirements, what is the amount that's left, which I can declare. So you will see three diagrams like this. The first one, for the three valuation method and the fourth valuation method will not have this diagram, but this diagram basically gives you an overview of your valuation methods, right? So hopefully in the next lecture and the following lecture, when we go deep into each method, in this case the DDM here, you can use this diagram as a summary of what you must include. Okay, so the first thing that's important is we need to determine the cash flows, right? The cash flows are your numerator. So we have covered the denominator. We have talked about in the first session, in the first part of our lecture, we have discussed a lot about the denominator, which is the cost of equity, the WACC, the cost of debt. So we've talked about this, right? The risk-free rate. We have discussed how we determine the denominator. So now we really want to focus on the numerator, which is the cash flows. So in the DDM model, the cash flows we're interested in is, of course, the dividends, right? But the question is, okay, then how do we determine the dividends? So we have the accounting method of determining where we just look at the retained earnings, right? Ending retained earnings is equals to the beginning retained earnings plus net income minus dividends. So long as you have a income statement, which will give you net income, and the retained earnings from the balance sheet, beginning and ending, you can actually derive the dividends, and this dividend amount will be your numerator. Okay, this method of using the accounting method is also called the clean surplus relationship. And you'll see this in the next few slides as well, in the later slides as well. But just remember that this concept called clean surplus relationship, and we'll talk about this, it's exactly the same. So in finance, we like to call it the clean surplus relationship. In accounting, it's the retained earnings formula, right? So this is the clean surplus relationship that we like to call in finance. Yes. Okay, so I really like the question. Can you just get the dividends amount from Refinitiv? Yes, you can, but then it might or might not, depending on the way they calculate dividends, it might or might not include dividends declared but not paid, right? And if you decided that, you know what, I don't want to include these dividends declared but not paid, you still have to give some justifications, right? Because if not, then the market was like, okay, I look at your valuation report, then I'll have a question, how come you did not include dividends declared but not paid? So you still have to give some justification on why you think not including it is the right way to do things. I really like the comment, right? So the financial statement is the only true source. So you can use Refinitiv, but you still need to read through a financial statement. So unfortunately, there's no shortcut to valuation, which is why your equity analysts in your banks or your investment firms are paid a lot, right? Because they go through the financial statements, the 100 over pages to dissect the information and read the notes, right? So unfortunately, you still have to go to the source information, right? But for whatever reason, if you are very sure that okay, the Refinitiv one is what is being presented in the financial statement, and you're sure there's no so-called funny things in terms of declared dividends but not paid and these kind of funny things, by all means go for it, right? Okay, now the numerator, we can use a second method. The numerator, we can use just the net income times payout ratio, right? So net income times payout ratio gives you the dividends. Okay, then we decide the expected growth. So expected growth, we have this formula which we are going to talk about in, I believe, the next slide, where we just take the retention ratio times return on equity. We just have quick handle. Yeah, it's next slide that we're going to talk about it. So I'll not discuss it too much. Last but not least, we need to determine this terminal value here, right? The terminal value is the state of constant growth forever, and we typically use the growing perpetuity formula to determine the terminal value here. And what's important I want to highlight here is that when we have a terminal value here, your TV, I call it TV, your TV here has to be discounted back to the present. And so this is important. You have to discount your terminal value back to present. And in the next lecture, when we dive deep into this valuation technique, we're going to have problems to work on, right? And we'll see that this discounting of the TV is very important. So we need to understand that the terminal value is as of, let's say, in this thing, year four, right? Year four. So this is year four. So we need to discount your TV back by 4 years. 1, 2, 3, 4. Jumping back by 4 years. You'll get the present value of your terminal value. Now, in terms of the sustainable growth rate, it can be calculated using the retention ratio times ROE. And ROE is just return on equity, right? Quite simple. What's your return divided by your amount of equity, right? Return on equity. Retention rate is basically just 1 minus your dividend payout ratio. What's dividend payout ratio is how much dividend you be paid. So dividends divided by net income, or dividends per share divided by earnings per share. Okay. So what's your sustainable growth rate? Basically, it's the growth rate of the company without the need to use debt or equity. There's this comment here on DuPont. This is really more for your class test, right? In the sense that if you're going to do your valuation report, the valuation report will never ask you what is the DuPont and DuPont decomposition of ROE. No, never ask you to do that because you have the information of the financial statement, right? Whatever information you need, ROE, you can just look at financial statement, you know it. Now, but for things like your class test, the class test is going to be can be very tricky, right? Let's say the class test tell you, oh, my total asset turnover is this, my equity multiplier is this, and my net profit margin is this. So you need to hopefully straight away be sensitized to, hey, you know what? This looks like my DuPont decomposition of ROE. So by multiplying these three things will give you my ROE. So hopefully you can see this, right? So in your class test, it can be very tricky where they give you very indirect information, and hopefully you can determine that this can calculate your ROE, and therefore you can calculate a sustainable growth rate here, right? So it can be, there's going to be like they will pepper some, more I would say gear questions to really determine whether you'll be able to get the A grade or you will not be getting the A grade but B grade, right? So they will pepper some more tougher questions, and questions could be something like this, right? It can be giving you the compositions of the DuPont, and if you are able to straight away see that it is equal to ROE, you can then calculate your G. Any questions here? Right? I think we're good. Okay. So that's the first analysis, right? Again, like what we discussed earlier, it's just going to be a very broad overview, right, of the methods. We're not going to detail. The details will be in the coming weeks. Okay, the next two methods we're talking about is this thing called FCFF and FCFE, right? Free cash flow for the firm, free cash flow for the equity. Okay, this slide is perhaps the most important in understanding the subsequent formulas, right? So I'm going to spend quite a bit trying to explain to you. And if you do have any questions, put them in group chat or you can unmute yourself as well. Okay, so the free cash flow to firm. In a free cash flow to firm situation, what you're doing is you're going to take the perspective of both the equity and debt holder. Okay? That means when you do the valuation, you're taking the perspective of both equity and debt. What does this mean? It means that you need, when you determine the numerator, which is the cash flow, you need to consider what is the cash flow to the equity and debt holder. So my question to you is, in this case, in your cash flow, should you deduct interest expense? You're right. Everyone understand why is it no? You're right. No, you should not. Okay. Maybe some of your yes, you're right. Because it's also for the debt holders, right? Because in your free cash flow to firm, you're considering the perspective of both the equity holder and the debt holder. If you're going to remove the interest expense from your cash flow, it's unfair because your debt holder is getting the interest expense, and that is the cash flow to him. And him meaning, in my perspective, right? Equity and debt holder. So you must not deduct interest expense. Okay, very good. The next one is if the cash flow is to your equity holder, FCFE, they're taking the perspective of only the equity holder. Means that you must consider any debt-related cash flow impact on your numerator cash flow. Meaning what? If there's an interest expense, you're going to remove it from your cash flow before using the cash flow figure for your FCFE. Because you're only taking the perspective of a equity shareholder. Okay. Having this in mind is very important because later you'll see many formulas. Oh, how come I must add interest? How come I must deduct interest? And then if you do not have this very basic concept of what perspective are you taking for FCFF or FCFE, you're just going to be very confused. And most of the time, in fact, even for me, when I was in my undergraduate, I just memorized, right? I just memorized, okay, FCFE, this is the formula, FCFF, this is my formula. But you do not really understand the background of, hey, why must I deduct here? Why I do not deduct here, right? So hopefully, um, I could enlighten you today so that in your future career, this is something that you forever remember, right? Okay. Having understand that, let's go to FCFF. So FCFF is to the firm. So whenever it's to a firm, you use the WACC, you have your cash flow to firm. This is what we are trying to calculate here in the next slide. The cash flow, it must be prior to debt payment, meaning what? Prior to the debt payment, meaning that you do not less of interest expense. Yes, right, interest, your EB, right, before interest expense. Okay, so again, we have this slide to give you a summary of what is important. Let's just cover the easier one first, right? In terms of denominator, we know is your WACC. We're going to use your WACC here. So your WACC, we already talked about it in much detail, so I'm not going to go through what's your WACC again. In terms of the numerator now, in terms of numerator, we need to consider the cash flow to firm. There's going to be this formula. It is an EBIT related formula, and in the next slide, we're going to have a lot of detail on it, so I'll not talk about it at this point in time. Okay, in the next slide, we'll discuss about it. And then we have expected growth. We recall that for your dividend discount model, we use the reinvestment rate times your return on equity, right? But in this sense, you use the return on capital here because this is your FCFF. Okay. Again, what we have to consider is your terminal value, which we typically use the growing perpetuity. And last but not least, I want to highlight this component here, which people think like, oh, not so important. So actually, every component on this summary slide for the three methods that we're talking is very important. So there's this small comment here, which is it could be like, kind of like a maybe even more of an MCQ kind of question, right? So if you are in a situation, if you are asked to calculate the FCFF, right? You ask you to calculate FCFF and do a valuation of equity, or not equity, do a valuation of the firm. What you are calculating is what? The value of the firm, right? The FCFF, right? You are calculating the value of the firm. So the question can be very indirect, right? The question can be using the FCFF, calculate the value of the firm and determine the value of equity. Then maybe you'll be like, what's happening here? How come I calculate FCFF, then they ask me determine value of equity? So you must hopefully be able to trick your mind to think that, hey, you know what? Actually, the value of the firm is equals to value of the equity plus value of the debt. I repeat again, the value of the firm is equals to value of equity plus value of the debt. And so if I take the value of the firm minus the value of the debt, I must get the value of equity. So again, this could be like a more differentiator question where they differentiate those that really understand the concept of value of the firm versus those that maybe just memorize the formula, right? So again, I repeat, if a question comes up where they tell you, oh, calculate the FCFF and from there determine the value of the equity, if they give you the value of the debt, which is what is given here, you must be able to realize that you can actually determine the value of equity from the FCFF valuation. Now, going to the numerator, we have the three components that we have a lot to discuss on. So your FCFF component is split into three parts: your operating cash flow, your NCS, which is your capex, capital expenditure, and your change in net working capital. So let's look at the first part here, operating cash flow. So operating cash flow, if we're going to start off with the basically the cash flow used for operations, right? And we're going to start off with the highest kind of level, or not highest level, but the most aggregated number, which is your net income, right? If we're going to start with net income, then what happens? Then we can, based on the net income, we must add back depreciation. Why do we add back depreciation? Non-cash, very good. Non-cash, add back depreciation, and we add back the interest expense times 1 minus tax. Why do we do this? This looks very strange. Why do we add back interest expense times 1 minus tax? True cost of debt. What does that mean? Because we are taking, okay, the tax deductibility, yes. The 1 minus tax, the tax shield, you're right. But why must we add back interest expense then? So you're right, there are two components, the tax deductibility. What about the interest expense? Deduct to arrive to net income, but you already have net income here. Okay. Okay, I like the comment because it's all investors. You're right, that's one of the reason. That's one of the main reason. What's the second reason? So main reason because you're FCFF, right? It is to all investors. So you need to add back the interest expense because your net income has removed the interest expense. Very good. What's the second reason? This one may be a bit tricky. So the second reason is what are we calculating? We are calculating the cash flow from daily operations. Generally, is interest expense considered operating out of cash flows? Not really, right? When we think about interest expense, it's about how much debt you take, the capital structure of your firm, right? Maybe you are a trading company. A trading company might require a lot of short-term debt for working capital. So then you have a lot of interest expense. But at the same time, compared to, let's say, a real estate company, maybe your interest expense will be lesser because a real estate company is going to take on long-term debt, and long-term debt generally have more expensive interest or high interest, right, for long-term debt. And so their interest expense will be a lot more. So immediately I hope you can see that the interest expense amount is determined by a capital structure of the firm, which then in turn is determined by maybe the sector the firm is in, kind of debt structure, is it a lot of long-term debt, is it mostly short-term debt? So there are many factors affecting interest expense, which then is not really relating to the operation of the company, operating cash flow of the company. So again, there are two reasons. The first reason is yeah, because of FCFN, and the second reason is because you are calculating operating cash flow. From there, we can use the EBIT formula and EBITDA formula, which is given here. At this point in time, I'm going to repeat what I said at the start of the lecture. We are not going to go through why the formula is like this because we are going to do a deep dive in the next lecture, right? Because you will see that you will question, hey, how come here we add depreciation? Why this depreciation here have a tax times tax rate, right? So we are going to address all these in the next lecture. But just know that you can use those two other formulas as well. If you are keen, you are a bit interested, you can flip to the lecture slides, which are already posted to see the derivation. So we'll go through the derivation of how we get the next two formulas, but we'll not go through in this lecture. Having said that, we're going to do the NCS. So NCS is your net capital spend. Your net capital spend, we're going to use the net FA, fixed asset, ending fixed asset, minus the net beginning fixed asset. Question, what is net fixed asset? What's this net? What does it mean? Okay, so maybe not too sure what's this net fixed asset. So this fixed asset basically means what? It means your gross fixed asset minus your accumulated depreciation equals to your net fixed asset. So you typically in the balance sheet, you'll see this, right? You'll see gross minus accumulated depreciation give you net fixed asset. Now, why when you use net, you add back depreciation because your net has already considered the accumulated depreciation. So then you need to add back the non-cash component of your depreciation. Now, in a situation where you just use the gross FA, you do not need to consider your depreciation. So again, this is unlikely going to affect your valuation report when you do your valuation of your firm because you can fit the data that is there, right, on the balance sheet. But in your MCQ, in your class test, this becomes very important because it depends on what the question gives you. You need to be careful whether you add depreciation or do not add depreciation. And again, they can be very tricky, right? They can give you gross, they give you net, they give you depreciation, and they let you choose. So you have to be very careful of what they give you. Last but not least, we're going to cover change in net working capital. So in classic accounting terms, net working capital here is CA minus CL, current asset minus current liabilities. What we're interested in finance is the change. So you need to consider the ending minus beginning, right? So this is important, we have to look at change. And in the later slide, we're going to see that this concept of CA minus CL for net working capital is a pure accounting concept, but in finance, things are a bit more flexible, right? In finance, things are very flexible, and you'll see different formulations of your net working capital. And in your valuation report, when you do your valuation of the firm, you must justify why you exclude or include certain things for your net working capital calculation. This is very important. You need to justify, right? And using the accounting concept of CA minus CL might not be the right way to do it. So you need to be careful when you calculate your net working capital. Okay, this is an important point. You need to be very careful for net working capital. It's perhaps the toughest to calculate when you look at a balance sheet. All right. So for FCFN, the difference is that we just need to use the return on capital, right? And now we want to go to the third valuation method. Okay, so before I go to the third valuation method, any questions for FCFN? No. All right. For valuation method FCFE, again, we have the summary slide here. So let's tackle the easy ones first. FCFE, because we are looking at equity holder, cost of equity. Okay, easy. Expected growth based on your equity, return on equity times retention ratio. Easy. Again, this is the same. We're going to use the terminal value using the grain perpetuity. This is again come easy at this point. Now, in terms of the numerator, this is the part that's different, yeah? Because we are interested in only the cash flow to equity holders, what do we have in this formulation here? We have this thing where we need to multiply by 1 minus debt ratio. Let me just see. I think the next slide. No, it's not the next slide. But let's go to this slide here first. So the question is, why do we need to consider? So this is exactly the same as earlier slide. Why do we need to take 1 minus debt ratio in your numerator formulation of your FCFE? And debt ratio is given by total debt divided by asset to the asset. Anyone? Why are we taking 1 minus debt? The leverage. Okay, yes, that is the leverage, but in what sense? Let's try to be more specific. Yes, you're right. To show the equity part. Because your FCFE, you're only interested in the free cash flow to the equity holders, right? So you need to consider we need not consider, we need to remove the debt component, so 1 minus debt, so that you only focus on the equity component of your cash flow, which is why we see the 1 minus debt that's multiplied into your capex. And your 1 minus that multiplied into your working capital. So this is one formulation you can use. So whenever you are given a target debt ratio in your MCQ question, in your short answer question, should always take on this formula. Right? Whenever there's a question on target, when they give you information on target debt ratio, please immediately use this. Now, then in your valuation report, you have the choice now. You have the choice whether you want to use this 1 minus debt ratio, or you can use the derivation from your FCFF formula. So your FCFE equals to FCFF minus the interest expense times 1 minus tax plus borrowings. And my question to you is, why do we need to minus interest expense now? Because it's for equity holders, you're right. So equity holders, so now you need to remove the interest expense because your your cash flow must be after considering what you pay for your debt holders, right? Because you're only interested in equity. And then we need to also determine what is the cash flow you have received from your net borrowings, where the net borrowings equals to your change in short term. Oops, sorry. No, I don't want to choose this. Change in short term plus change in long term debt. Okay. So how do I get the next formulation here? Basically is you plug in the value of your FCFF formulation. based on your NI formula. So I'm just going to flip over. I'm not going to rewrite this. So basically, I'm just going to use this NI formula here. And what happens is your plus interest expense times 1 minus tax. This component gets cancelled out by this component here gets cancelled out, which is why you're only left with this here for your FCFE. Okay. Going back to one slide, this is just a slide summarizing the value of the equity is given by a cash flow, some divide by your return on equity, and you sum all of it, right? Just a small comment here that your DDM is a specialized case of your FCFE because you also use the return on equity. However, you really just focus on your dividend received. Okay, let's answer this question, right? So given you have this, given that you discount cash flow to equity, should you use the dividend discount model or your FCFE? So maybe it's a bit intuitive, right? So if a company pays dividend, generally you can use the dividend discount model. Maybe the amount of dividend they pay is close to your FCFE, there's no difference, right? Rather than spending so much time to calculate all your cash flow to equity, which is you saw how complicated, how many steps there are, you can just use the uh, dividend discount model, which is relatively easier. However, there are some cases where your FCFE can be hard to estimate, like a bank and financial service firm, then DDM might be better. Use the FCFE intuitively. If the company does not pay dividends, then of course you can't use DDM, then you just use FCFE. But there is this interesting rule of thumb here that says that if the company pays dividend above or below 75% of your FCFE, then should use your FCFE, right? If it pays significantly higher or lower, which is around 75%. This might be a bit of repeat now that we have dissected the reason why we have the interest expense, but I'd like to go through it. So should you use the FCFF or FCFE? Okay, so use the FCFF whenever we, of course, we want to consider both equity and debt holders, right? And you will notice the difference for FCFF in the sense of your 1 minus uh, tax expense times interest expense, in the sense you're adding back the interest expense there, right? And why do you add back the interest expense is because you do not take into account the interest expense in your cash flow because you are taking the perspective of your debt and equity holders. We can use this FCFF whenever we see that there is a drastic change in your leverage, right? When the leverage is changing a lot, then because we are removing the effect of debt from the cash flow, then the FCFF might actually be better. If you have partial information on volatility and leverage, then of course FCFS is better. In all cases, we're interested in valuing firm, of course, instead of equity. Now, if you have firm with multiple divisions and different growth prospects, then maybe it's just better to value the entire firm and not just to the equity holders, right? Because you have many segments, you have many divisions, then you just want to value the entire firm instead. At the same time, if you are able to isolate one component of the division, then you can use the FCFF for the valuation of one component. Because if you're going to use the FCFE, then it's going to be very complex, right? Because then we need to consider, oh, how much of the division is taking on this much of that? Yeah, it's going to be very complex. So if you're just going to make it simple, FCFF, if you're going to value one division out of many in a company. When you use FCFE, it's taking from a perspective of equity holder, we do see the effect of debt adding with the less of the interest expense, meaning that you are going to take into account the interest expense in your cash flow in your numerator, and you add back your net borrowings as well, which means that you're going to consider debt as well. And last but not least, your one minus debt ratio because you are apportioning your cash flows to debt and equity, and you're only considering the part that is for equity. You can use your FCFE if in case there are stable leverage. So the leverage is not changing. Stable leverage, the firm has a clear capital structure. So there's not going to be a drastic change in the leverage, the debt ratio. Maybe it's just a single division, so it's easy. Does not pay free cash flow as dividends, meaning that you cannot use your dividend discount model, so no choice, you use your FCFE. Okay. Okay. Again, I think it's about time. Let's take another 7 minutes break. We'll come back at 9:15. You do have any question, put down in the group chat. If not, yeah, I'll see you back at 9:15. All right, welcome for the last part of this lecture. So we have covered the three valuation methods so far, right? The three valuation methods use the cash flow type of valuation to determine the value of your equity, where we have that three summary, right, that we have went through. Okay, so the last method we're going to do an overview on is your residual income. What's residual income? So the residual income model, unlike the three models that we initially talked about, is going to be slightly different, right? So the last three models we have discussed has been focusing on the financial statements, the accounting profits, net income, EB, right? Everything's accounting, right? So accounting profit simply takes the revenue minus explicit cost. A explicit cost relates to expenses. Right? Expenses, there's explicit, right? There's like extra costs. In your residual income model, the difference we are going to make here is we are going to consider the economic profit. And what is economic profit? So economic profit considers all costs, okay? And all costs means the inclusion of both explicit and implicit costs. Implicit cost is what? Is cost that might not be in the financial statement. It could be a loss opportunity, right? The loss of opportunity is your opportunity cost, which is implicit. So how do we determine this implicit cost? In your residual income model, we determine it by relating this cost to your equity charge or your cost of equity. So your cost of equity should consider all costs, implicit and explicit, in that line item called cost of equity. And we use this cost of equity component to determine your economic profit by taking net income less any cost relating to cost of equity to give you your residual income. And the idea behind residual income, this is something new, is actually just measuring the increase in the shareholder equity. So the increase in shareholder equity is simply what? Is simply the amount of profits remain after providing all capital providers. So to measure the increase in shareholder equity, what do we need to start off with? We need to start off with, in terms of valuation, we need to start off with the current book value of equity, right? What's the current book value of equity? Plus any residual income that you get, right? So imagine you have book value here, which is your shareholder equity. Every year you have more income that is going in, right? More residual income that is going in, which is, as the name suggests, residual, what is remaining after considering your cost of equity or equity charge. So you need to present value it because obviously you're in finance. You present value your residual income into your current book value of equity. Immediately, I hope you notice something. Where is the bulk of your valuation coming from in your residual income model? Okay, not really. So the question is, where is your bulk of your valuation coming from in this residual income model of valuing a company? I hope maybe it's not so clear because it's also a new concept. It, you can see that it usually comes from your current book value of equity. Why? Because you have a current book value of equity and you're just adding any incremental residual income into your current book value of equity, which is the bulk. Yeah, you can see that. So that's the difference here. Okay, that your bulk is in your current book value and adding and all your residual income in. So the question is, okay, you have your current book value of equity, right? This can be easily derived from your balance sheet. Then the question is, how do I calculate your residual income? So that's where your formula come in. So this residual income here is simply, oops, I'm sorry, is simply this component only. Yeah? There are two components here, 1 and 2. It's only tackling this component here, component 2, the residual income. And your residual income is calculated by taking net income minus equity charge, like what we talked about. Then the question is, what is equity charge? Equity charge is what? Is basically just your cost of equity, cost times your book value of equity, right? So your book value times the cost gives you the equity charge, and you minus your income, that income gives you residual income. Now you see a lot of tiny highlights here. Do you notice the net income is at a period T, but the equity charge is T minus 1, meaning one period before. The question to you is, why is there a difference in terms of this timing? Why is net income T and equity charge T minus 1? Okay, reporting time difference, not really. Good try. Um, because you haven't at current period of residual income, about there, but not really there. About there. Okay, not really because of that. Okay, so this is a bit tough, right? So let's try to think about this, right? How do you, so equity charge is based on book value of equity, right? Now, the book value of equity, this value, let's say the beginning book value of so T minus 1 equals to beginning book value of equity, right? The beginning book value of equity is the equity amount that will allow you to generate the income for that year, right? So if you're going to use the value of equity now, the value of equity now is going to include your net income already. So you're going to double count your net income. That's one. And number two is what I mentioned earlier, is that your book value of equity, your beginning book value of equity, which is T minus 1, is the value that's going to generate your net income for that year, which is net income T, which is why your equity charge is always one period behind, because it is the amount of book of equity that is required at the beginning to generate your net income. And if you going to use equity charge for the same period as net income, you're going to double count your net income. Is that clear for everybody? So this is also one of those things that, when I was studying this topic way back, it's like something like, oh, I just memorized because maybe my lecturer didn't mention this. Uh, why is it like that? So, oh, okay, let's memorize. Okay, the equity charge is one period behind, but then really it's about understanding it so that you're not memorizing formulas like this, right? It's similar to what we discussed earlier as well on the FCFF, SCFE, and all those things. So I hope you can see that the equity charge is one period behind because it is the amount of equity that's required to generate the net income now, which is T period. And if we are going to consider the equity charge for the same period, we're going to double count the net income. Because remember, what's the formula for um, retained earnings? So retained earnings is you're ending your clean surplus relationship ending retained earnings equal beginning retained earnings plus net income minus dividends, right? And this retained earnings adds to your capital, which then gives you your book value of equity. Okay. Okay. So we can further decompose your net income into ROE times book value of equity, right? So if you have your return on equity, you multiply it by the book value of equity, it gives you your income, right? ROE is what? Return, which is net income divided by equity, right? And if you times by equity, you cancel equity, you get your net income here, NI. So net income equals ROE times book value of equity. And we already have decomposed this component. And then what we can do is we then aggregate the equity, book value equity and book value equity out like this. Then you'll notice, hey, how come there's two formulations here? These two formulations are exactly the same, other than the fact that the second formulation is per share. And why I like to segregate both the formulation is because for when you see a question giving you earnings per share, right? You might not immediately think earnings per share as net income. You might not be immediately clear. And from there, you might not realize, hey, actually, with earnings per share, I can actually calculate the residual income, which is what I'm trying to emphasize here by separating residual income and residual income per share. So if you do see earnings per share, it's part of the formulation of residual income in your, and this is typically your class test kind of questions, right? Um, this is what I was trying to share here, plus capital, where retained earnings is this component here, ending retained earnings, and your paid up capital is your this component here. Okay, equals to book value of equity. Now, by using this residual income model for valuation, so we're thinking about valuation now, we start with two components, right? Book value, and then your summation of your present value of residual income here, as what we have highlighted here, right? Part one and part two. So a lot of words here, but the idea behind it is what? So let me explain to you all these words. You can read through it on your free time over the weekends. But the idea here is what? The residual income model uses the clean surplus relationship, right? And what's the clean surplus relationship? Remember, the clean surplus relationship is what we have talked about here, right? Retained earnings, ending retained earnings is equal to beginning retained earnings plus net income minus dividends. Now, the residual income model relies on the fact that the clean surplus relationship is true, meaning that the only thing that can change retained earnings, can change the book value is your retained earnings, i.e., this one, right? The only thing that can change is this. However, we know that it's not true because if you're going to flip your financial statement today, you'll notice many things can change your book value of equity. Things like capital injection, share options, share buybacks, they can all change your book value of equity. But not only that, there are things in the OCI, other comprehensive income. So if you go to flip your income statement now for any listed company, you'll notice this thing called OCI, which is the item below the net income. And so this item below net income, meaning that it's not going to be added to the net income, it's below the net income, right? After net income, they have other things below. these are your OCI items. Your OCI items are typically things that was going to affect your equity, but not your P&L. Okay, I repeat again, your OCI items are affecting your equity, but not your net income. And so it becomes very disproportionate, right? Most of the items that is above your net income is going to affect your net income, which then in turn affect your equity via your retained earnings, right? Via retained earnings is going to affect your equity. So in these few items, which includes things like translation gains and losses, hedging gains and losses, they are going to only appear in your OCI, which means that your retained earnings is going to capture certain things that does not capture your income in your net income, which then becomes problematic when you think about the clean surplus relationship. Nevertheless, if you're going to use your residual income, we're going to assume that the clean surplus relationship holds. And so based on the clean surplus relationship, we know that the ending retained earnings equals the current book value equals to previous book value plus any retained earnings given by this. And we can determine what is retained earnings. Retained earnings is given by the formula that we have discussed earlier. And so using this, we can plug in the retained earnings inside here. We give you this book value equals to book value at the current book value equals previous book value plus net income minus dividends. All right. And what we're trying to do here, then we are trying to determine, hey, you know what? Is actually the residual income model aligned with the three models that we talked about earlier. And then we realized that actually there might be some relationship between the residual income model and the discounted dividend model, the DDM. And so let's try to prove to ourselves that there's some relationship, right? So we start with the DDM, which is this that we have discussed. And by using the clean surplus relationship, we have determined this in the last slide. We can rearrange things here and there to get dividend as the subject of our relationship. And then we notice something, right? We notice that in our residual income model, in our clean surplus relationship, we have the book value, previous book value minus current book value, which is actually just given by this part here, right? And then your net income is given by here. It's not fully this because there's going to be some beginning book value, but it's about there, right? So your net income is here, your book value is kind of this component here. And so because of this, we can see that dividends here, this one, is equals to this thing, which is then equals to this thing here, which shows the parallel between your dividend discount model and your residual income model via the clean surplus relationship. Questions? So now let's compare the residual income model. Again, this is just going to be a broad overview, so we're not going into too much detail of residual income model. But let's just think about some differences, right? So each model is derived from the same underlying. We have proven that the dividend discount model and residual income model can be related. So the degree of input or forecast varies accordingly, right? We see that there's a lot of judgment required in determining or actually choosing which or choosing the methods used for each component of our valuation. What's interesting is for the DDM and your free cash flow model, we typically start with the cash flow and we then at the end determine this thing called terminal value, right? Which I say is TV, which then have to be discounted to present. The TV in the last three models that we talk about would constitute the heaviest contribution to your valuation. This is very unlike the residual income model, which we have established at the start of the discussion of residual income model, that the main bulk of your valuation comes simply from the book value of equity, which is not something you estimate, it's in the financial statement already, right? So in this sense, when we compare the last method and your residual income model, the weight of which component is contributing to the main valuation is very different. In your residual income model, it is the beginning, the book value that we use that contributes the largest. While in the case of your DDM and FCFE, SCFF, is the final component, which is the terminal value that's contributing the maximum. Or we can see this, right? That there are different components that's contributing to the weight of the valuation here. So residual income starts with the base value of using the balance sheet figure. We use residual income for situations where maybe you have some negative cash flow, or maybe the terminal value cannot be determined with certainty. The residual income model can be used to check some consistency in terms of results. So because the residual income model uses the return of equity, we can actually use the residual income model to check whether the DDM or FCFE is accurate and consistent. Any questions on residual income model? Right? So if no questions, we have covered the four key methods which we are going to dive deep in the next two lectures. Today is an overview. What I would like to do as a round up to today's lecture is to go through this very comprehensive example here in terms of how we use each method for the calculation, right? So in this question, we are given what? Let's look at what we're given. We're given the income statement, we're given a balance sheet. Okay, what's the question here? So Rainbow Manet has a dividend policy of paying 60% of its earning as dividends. The company plans to undertake expansion of its business and estimates that it needs 5 million of additional investment in fixed asset in 2007. The working capital is expected to increase by 500K in year 2007. The cost of equity is given at 12% here. Okay, 60% is the dividend policy. We have four parts of the question, right? The first part, we have the number of shares 1 million. We have four parts of the question. The first part is the dividend per share, calculate the dividend per share for 2006. So for 2006, what do we have? We have the earnings, right? The earnings is given in the income statement. So let's look at the net income. Net income is 5,200, right? 5,200 is the net income. So 5,200 we divide by 1,000 or 1 million. Okay, right? 5,200 divided by this, we get 5.2 in terms of earnings per share. And we know from the question that they pay out 60% of their dividends here as earnings. So we just multiply by 60 and we simply get the dividends per share, 3.12. On the other hand, we can use the clean surplus relationship and look at the balance sheet figure instead, right? So we are going to look at the combination of these one, right? Paid up capital plus retained earnings. So we're going to have the ending retained earnings, which is here, and the beginning retained earnings, which is here, right? And then what are we going to do with the, you're going to add the net income, which is what we have decided earlier, 5,200. So 5,200 is your net income. And from there, we can determine the dividends as in paid. Once you determine the dividends paid, again, you divide by number of shares, and we get 3.12. So second method. The second part of the question is free cash flow to firm. So free cash flow to firm, FCFF. Now we start off with the basic formula of FCFF, right? Which is this. So operating cash flow, we need to determine operating cash flow. We determine the net capital spend and the change in net working capital. So let's start with the operating cash flow by using the formula of EBIT. So let's start with EBIT, right? I'm going to flip back to the slides. The question. So what's EBIT? EBIT is 8,000 here, right? We are given EBIT is 8,000. I know we need the depreciation as well. Depreciation is given by here, 2,000 of depreciation. Our interest expense is also going to be 1.5 thousand, right? So we have this. Sorry, we need not interest expense. Interest expense is for FC. Actually, we don't need interest expense at all. Yeah, because we are not using the net income formula, so we don't need it. In any case, we have your EBIT 8,000 and your depreciation 2,000 multiplied by tax rate, which is given in the question earlier. And so we determine your operating cash flow. Then we have your NCS, right? So NCS, recall that we mentioned you can either use the you can either use the net or your gross, right? And I want to show you that the net and gross actually gives you exactly the same answer here. So in the net version, let's flip back to your balance sheet. The net version, where's your net? So your net is here, right? 24,500 and 21,500, right? Here's your net. Your gross, on the other hand, is this, right? 25,000 and 30,000. So if I'm going to use my net, as what I mentioned, 24,500 and 21,500, I would have add back my depreciation, which is what we have earlier, to get your NCS. But if I just use gross, I need not care about your depreciation anymore because it's on gross basis, because we add back depreciation simply due to the reason of no cash. So I determined my second component. I'm happy already. The last component, which earlier I mentioned, is perhaps the toughest to determine, which is your change in net working capital. So change in net working capital, in this question, there is a small little caveat here where they say that in this change in net working capital, we're going to exclude certain components. We're going to exclude cash and short-term investments, as well as interest on debt such as loans and bonds. So the question I'd like to ask everybody is, why do we exclude cash and short-term investments in your working capital calculation? So this is more of a finance way. Non-core, what does it non-core mean? What does non-core? Cash is not a core. Mm, it is not, oh, okay, you are about there, but why is it not part of operations? You can't sell cash. But then, okay, yeah, you can't sell cash because cash is the most liquid. Okay, not really that. It's about there, but not there. Okay, let's try to think about it, right? Okay, let's think about short-term investments first. So short-term investments, very clear, it's not part of operations, right? Let's say you put your cash into a deposit account for 1 year, short term, you can't use the cash, right? It's in a deposit account. You can't use for operations. So that's quite easy. Now, why is cash excluded? Think about this. How do we get cash? How do we raise cash? Cash is not raised simply by selling products, right? You can raise cash also by taking on loans, taking on debt. So when you take on more debt, when you issue more equity, you're right, yeah, issue equity, you raise more cash. So your cash not necessarily be related to operations. It can be related to capital structure. Yeah, pumping in equity, you're right. So because of that, cash should be excluded based on finance rules. Now, interest-bearing debt, such as loans and bonds. So this obviously is more short-term related, right? Short-term loans and short-term bonds. Now, the question is, why are these short-term debt and short-term loans excluded from changing net working capital? So maybe this is not so obvious, right? So that is required for working capital as well. That's why we have working capital financing in banks and all. Now, which portion of this debt is typically excluded is things like current portion of short-term debt. So the current portion of short-term debt is relating to a long-term debt, just that there's a portion that's going to expire 1 month, so 1 year, so it becomes a current portion. So those shouldn't be included. Lease liabilities, you're right, shouldn't be included as well as derivative liabilities. These are not really relating to working capital. So when we think about it more and more, we see that the working capital formula is really quite cumbersome. There's a lot of things that you need to justify, you need to adjust. It's not simply just CA minus CL, current asset minus current liabilities. Right? I hope this is the point I want to drive to you that when you do your valuation report, we need to be very careful and justify why we use certain parameters. Now, going back to this question, our CA minus CL, what are we using here? Your CA, we're just going to focus on your inventories, receivables, and other current asset. In terms of your debt, we are just going to focus on your payables and your other current liabilities. We are going to exclude any short-term debt. And with that, we can determine our change in net working capital because we are doing changes, those not working capital, but change. Then we can determine the free cash flow to firm quite easily based on once you have the three parameters. However, we just need to be careful that we cannot calculate the free cash flow to firm per share because we include all capital providers. With this, we can also calculate the free cash flow to equity. We would like to use the formulation here The thing that we calculate now is just the net borrowings, where net borrowings is what? Is change in short term plus change in long term. So let's just quickly flip back and see what are the long term and short term debt. Long term debt is given by, sorry, the long term debt is given by this, short term debt is given by this. So we can determine the changes in the long term and short term debt, get this, and then we can calculate the FCFE, and then after that we divide FCFE by the number of shares, because now it's to shareholders only. We can get the FCFE per share. The last part of the question, we calculate RI, residual income. The question is, let's just flip back to the question and see what they want you to calculate. They're asking you to calculate residual income. This is not asking you to value the firm using residual income. It's just calculate what is the residual income. Because remember, when you have value firm, we need to plus the book value of equity, right? So again, this is a small little kind of small tricks that they like to put in the question to recap really what they're asking for. Are they asking you to value the firm using residual income model, or are they asking you for the residual income, which is just RI? Okay, so in this case, it's just RI. So in the case of RI, we take net income minus equity charge. We are given that the cost of equity is 12%. You just take the book value equity at t minus 1. So this is the part that's important. I'm just going to flip back to show you where is t minus 1. It's here, t minus 1. This is t minus 1. Okay. And of course, we're going to use the net profit here. For this, we can calculate the residual income per share. Just divide that by 1 million. Right. I think that's all we have for this lecture. So I hope that this lecture gives you a broad overview of the quantitative methods we are going to go deep dive into for your valuation techniques. Again, like I mentioned repeatedly in this course, is that we're giving you tools, different tools to value the firm. It's really up to you to choose what you want to use, RI, FCFE, FCFF, and the various formulations of the components. So this gives you a broad overview. And yeah, that's all I have. Any questions, any comments, maybe feedback you would like me to go through certain parts a bit more in the next lecture? So should you be using all different valuation methods or choose the most? So choose the most appropriate um, and try to do some justification. If you feel that the most appropriate is your dividend discount model, try to put strong justification. I would caution you to use the dividend discount model because it's the simplest model. Generally, the marker for your ECA, it really depends. I'm not sure whether I'm marking it, but generally the marker would like to see that you understand the methods taught. So using a more complex method, maybe the FCFE, SCFF might be a better option. Let me just pause the recording.